The escalating U.S.-Iran conflict has pushed oil prices higher. The Wall Street consensus is that the impact on the U.S. economy will be limited, and while the timing of Fed rate cuts may be delayed, the direction remains unchanged. The key variable is whether the Strait of Hormuz faces a prolonged blockade. Oil prices have spiked in the short term, but estimates suggest this would only add 0.1 to 0.3 percentage points to U.S. inflation, and that impact would take months to materialize. U.S. inflation is already hovering around 3%, and tariffs have already added roughly 0.5 percentage points. The oil price increase is an additional pressure, not the dominant driver. The Fed's core inflation metrics exclude energy prices, and officials are more inclined to view energy price swings as temporary supply shocks rather than signs of demand overheating. On the growth front, multiple estimates suggest the conflict would shave at most 0.05 to 0.08 percentage points off U.S. GDP growth, a modest drag. Higher oil prices squeeze consumption among low- and middle-income households, but the broader U.S. economy remains resilient. The U.S. is now the world's largest oil producer, with dependence on Middle Eastern oil at historic lows. Energy self-sufficiency provides a significant buffer against external shocks. Looking at history, similar regional conflicts have typically been short-term disruptions with limited long-term economic impact. During the 2025 Israel-Iran conflict, oil prices spiked, then quickly fell, and the U.S. economy saw no significant effect. Market expectations for Fed rate cuts have been significantly scaled back. A March cut is effectively off the table, and the probability of a June cut has cooled notably. While July remains the baseline for a first move, the wait-and-see sentiment has intensified. Former Fed Chair and current Treasury Secretary Yellen noted that the Iran situation would make the Fed more inclined to hold steady and more cautious on rate cuts. With inflation still above target, higher oil prices could entrench public inflation expectations, complicating the Fed's policy calculus and strengthening the hand of hawks favoring higher rates. Higher oil presents the dual constraint of pushing inflation up while pulling growth down, reinforcing the Fed's data-dependent, patient stance. The policy path ahead hinges on how the conflict unfolds. In the base case, a contained conflict with the strait remaining open, oil prices ease, and the Fed could still deliver its first cut in July, with 2 to 3 cuts for the full year. In a risk scenario, a temporary blockade of the strait, oil breaking above $90, rate cuts would be pushed to September, with just 1 or 2 cuts in total. In an extreme scenario, a prolonged blockade, oil above $100, stagflation risks would rise, the odds of any cut this year would drop sharply, and discussions of a rate hike could even resurface. Wall Street firms have reached a consensus. The economic impact is broadly manageable, posing a systemic risk only in the extreme case of a prolonged war and extended blockade of the strait. On policy, rate cuts are delayed but not derailed. The Fed will be more cautious but will not pivot to tightening. In the near term, markets are in risk-off mode, with risk assets under pressure. The common advice from institutions is to avoid rushing to buy the dip and wait for clarity. Going forward, 4 key milestones will shape the evolution of rate cut expectations: the March 2 U.S.-Iran technical talks in Vienna, the status of shipping through the Strait of Hormuz, the policy signals from the March 19 FOMC meeting, and movements in gasoline prices and inflation data. In summary, the U.S.-Iran conflict is creating short-term turbulence for the U.S. economy and Fed policy through the oil price channel. But it is unlikely to alter the underlying resilience of the economy or the broader direction of rate cuts. The impact is modest, the timing is delayed, July remains the baseline, but patience is required. That is the core takeaway.